You're tuned into the Wade Borth Podcast, the place where clarity replaces confusion and real conversations open new doors for your financial life. Let's dive in and rethink what's possible.
Hello, welcome back to the Wade Borth Podcast. Today we're going to talk about a question that's been coming up a couple of times, that I thought maybe just be really helpful to address. At least bring some conversation around it. Maybe that's probably the best way to say it. And that is, we've had a couple of questions about, life insurance companies, how safe are they, right? And I'm like, man, that question is like, it gets asked a lot. And I'm like, life insurance companies are, to me, the safest, especially life insurance companies. Make sure we differentiate between life insurance companies and property and casualty companies. They're different. They kind of do the same thing, with manage risk, help you manage risk. But more importantly, life insurance companies are really operated at a much different level than property and casualty companies. And so I was visiting with Chief Investment Officer, of One America, and he made a really good point. He says they are in the position of being the provider of capital when everybody is searching for capital. And I found that really, it was interesting, but it was also like reassuring. Like when they're always in the position to provide capital when everybody else is in search of capital. And from a safety standpoint, I thought, man, that is huge, because what does that mean? It means like when everybody else is losing their head, they're out there, finding deals. And so sometimes when times are really good, they just don't look as attractive because they're setting aside some dollars. They're keeping their powder dry. So when times aren't so good and we have events in our economy and really what's going on in the country, they can take advantage of those. So I think from a safety standpoint, it's really clear that they are, I would say, the safest financial institutions that are out there in the country right at any time, not just right now, but at any time, because they have to do things differently. They don't use leverage. They're thinking long term, right? I love the expression, and people have probably heard me say this before on the podcast. Insurance companies aren't looking at the next quarterly conference call, at least mutual insurance companies. I'm going to probably even narrow it down to mutually owned insurance companies, which are those companies that are owned by their policyholders. So you're not a customer of the company, you are an owner of the company. So these mutually owned insurance companies, they're not thinking the next quarterly conference call, they're thinking the next quarter century. And quite frankly, like Chief Investment Officer said, he says, we're making promises to pay claims 100 years from now. And I'm like, that's a tremendously different focus than those companies that are using venture capital, to fund their operations. So because the pressure to have performance early is so much greater, so they're having to take different risk. It's not good or bad, it's different, and we just need to understand that. So I'll talk about that just here real quick. But so these mutual insurance companies are focused completely different than a lot of than either stock-owned companies, Wall Street-owned companies, venture capital-owned companies, private equity companies, because their focus has got to be completely different. It has to be very much from the long-term perspective and not from a quarter-to-quarter perspective. So they don't manage from quarter to quarter. And what they do is they say, where can we put our money so we can know that our money is going to be available 10, 15, 20, 25, 30 years from now. And then having some cash flow from that will help the operations of the business. And so it's a different mindset than saying, what's our rate of return on a, quarter Q2, Q3, Q4 conversation. So anyhow, it is a different conversation when you look at mutual insurance companies. And the safety aspect goes way up when they change their focus, right? So they're not having to take immediate risk, and they understand risk, and they're doing this at a, we have to kind of understand what they're doing compared to the individual investor. And so this is where I think we get a lot of confusion. Is like we have individual investors going, oh man, are these things safe? And why aren't they getting a better rate? Or a lot of the questions because they don't understand what they are. And so what I mean by that is, these mutual insurance companies, really a whole life policy is just a professionally managed bond and real estate portfolio that's done at this institutional level. Now, we've done podcasts talking about this, but just think about that. They're doing this at an institutional level. So they're finding deals that you and I as individuals are never going to find, no matter how big an individual we are. We're just not, unless you're a Warren Buffett, but really he's at institutional level as well with Berkshire Hathaway. But the point being is that they're doing this at an institutional level, and they're professionally managed money managers, bond managers, right, real estate managers. That's all they do. It's not a side gig for them. It's not something that they do but they're doing it at a professional level. So, and then the beauty of having a whole life policy is it's guaranteed never to go backwards. So these guys are managing all the risk and they're taking on all the risk. So you can have that asset, that whole life asset, that liquidity contract called whole life. And what you do with it is really up to you, and you can have conversation around, but just understand the safety of this. And so, and I also have heard like, well, what if, something happens where hyperinflation or the reserve currency is not the US dollar. Everything's transacted in US dollars right now for the world reserve currency. And I was thinking about that. It's like, well, why is that such a big concern? Is it the smallest thing that's probably never going to happen? Because again, you have to understand these companies are managing for the probability of a certainty of a death, right? That's where they start. There's 100% certainty that we're all going to die. So they're managing it from that standpoint. And so now you take it to the other end of the spectrum. It's like, do they manage to the 0.5% or 1% that something might happen? They're probably aware of it. It's probably on their radar, but I don't know that you manage to that. And so I think we have to put it in perspective and also understand that if things are changing in the economy, they're also going to change. Right? Their obligation is to provide value to their policyholders. And if they have to make a change, if they have to say, hey, the world reserve currency is changing or whatever it might be, they're going to make changes as needed to bring the value. They're not going to say, well, we're going to do it in US dollars. And if the US dollar is no longer here, tough luck, you're out of business. Right? They're going to transition. And just a really good example of this, I don't know if anybody's ever heard of Lloyds of London, right? Lloyds of London, I believe, if I remember the story right, it's an insurance company that was started in 1680, I believe, 1680, 1670, something like that, just to insure ships going back and forth. And so they would underwrite the probability that these ships would sink and they would lose their cargo. And so they would all pool together. This is what insurance is, right? And at that time, England was the world power. It was the top dog back in the late 1600s, early 1700s. There was Spain and some other companies, France at the time, I believe, but they still were the primary power that was out there. And so everything was done through the British pound, right? That's how everything was transacted. And now that's no longer the case. After World War II, the British pound doesn't have the authority that it used to. It's the US dollar. But Lloyds of London is still transacting. Again, I have a disability policy with Lloyds of London. And, if I get disabled, they'll pay me in US dollars. Or if I was in England, they would pay me in the British pound, right? So they have the ability to transact wherever they need to, and they have the ability to shift as they need to as well. So I hear this like, well, what if this changes? What if this changes? Well, I'm sure it's not happening. I'm sure these companies are unaware that these things are happening, and it's probably a thought in their head. And I know they think about these things. We've asked them in the past, what are you doing? He said, well, we manage for the bigger probabilities, but we're also aware of some of the things that might happen. But if you manage to all those things that might happen that never do, then you kind of get lost and you lose your focus. And I really believe that you lose what you're supposed to be doing. So I think, and again, I know just because I talk to these individuals, they're aware of all these things that are going on, but how much credence do they give it? Maybe when it becomes a hotter issue, bigger item, they will, but just understand they're going to be pivotal as well. They can move when they need to move. And again, I use the Lloyds of London. They were doing what they were doing back in the day when the British pound was like the top dog. It was a world reserve currency. And when that changed, they didn't go out of business. They just started transacting in US dollars, or again, whatever company or country that you were in. So I just want you to give that a little bit of thought as far as safety, as far as like transactions in the country that we're in and being able to handle shifts in the economy. They are well positioned to be able to do these things. And again, I've been doing it for 35 years, so it's a blip on the radar. But we've seen all kinds of crazy things happen. And I'm going to use COVID. I'm going to go back to the Spanish flu of 1919. These were big events in the world, right? I'm going to go back to Spanish flu because it was interesting. When COVID happened, I did a lot of research on the Spanish flu, thinking, how is this going to affect the insurance companies because people are dying. And in 1918, the Spanish flu that was affecting like 35-year-olds. It was people in their prime earning years. And what it did is there's a spike in the amount of claims they had to pay, but it lowered their dividends, it lowered their profitability because there was claims that they hadn't expected to pay, but it did exactly what it was supposed to do. It paid claims. And so all these things that are like major catastrophes, which they are, COVID, recession of '08, the Spanish flu, the dot-com bubble, debacle, all that, they just truck through because, again, they're not living from quarter to quarter. They're living from quarter century to quarter century. And so when these events happen, they roll with it. They go, yeah, we're prepared for that. We got reserves for that. They didn't predict it. Nobody could have predicted those things. But what they could do is they were prepared for it. And that's the big difference. When you have a really strong mutual insurance company, they're prepared for these things and they have reserves for them. So I guess I would just say, if these are thoughts, hey, just understand they hear these thoughts. They probably have them as well, but they're keeping their eye on the ball 15, 20, 50, 100 years down the road. And so they look at it as potholes. And if the environment changes that we have to transact in, they'll shift as well. It's not like they're going to be out of business. So I would just caution you to not let the thing that might not happen, more than likely is never going to happen, be the thing that you focus on. Focus on the things that are going to happen. We're all going to die. We're all going to have an event in our lives. We're all going to need cash. We're all going to need capital at the time of death and any time before that. So those are the things we know are going to happen. We don't know when. That's the big thing. And that's where the insurance companies are really good. When those events happen, we know that they are the ones that provide capital. They're the ones that provide, the liquidity when people are looking for liquidity. And you can rest assured that, they're going to be strong and they're going to be there, especially, and I'm just talking about mutual insurance companies. These are the greatest run businesses I can see in the financial world, just because they have a different focus. So anyhow, thanks for listening to this. It was just, I wanted to kind of share this idea because I've been hearing, and it comes up every couple of years. Well, what if this changes? What if this changes? And life is always going to change. That's probably the only constant we have is like things that we don't know that are going to surprise us. But more than likely, more than ever, things are always going to come back to being the same. There's a book by Morgan Housel called Same as Ever. Geez, I had a moment there, but called Same as Ever. And it's kind of the same thought process. Like Jeff Bezos says, everybody's asking what's going to be new. And he says the question they should be asking is what's going to stay the same. Because what's going to stay the same is where you can, plant your flag and find profitability and certainty. And that's what most people want in order to grow, growing within their lives. Like, what's going to stay the same? He makes the point with Jeff Bezos makes with Amazon. People want lower prices and they want to deliver quicker, right? He says that's always going to stay the same. So they built a business model just off that, not what's the new gadget, what's the new thing coming up. Sure, they'll pay attention to it, but it's not the thing that's going to make them rich. So anyhow, thank you for your time. I appreciate it. I would love to hear from you. I'd love some comments. Subscribe, share this thought, because I'm sure there's a lot of people out there that are having this. So I'd love for you to share this podcast. And if you got more questions, you want to talk deeper, reach out to us. Go into the show notes. My email address, our website is in the show notes. It's wade@sagewealthstrategy.com. And reach out to me and let's have a conversation about what kind of certainty are you looking for, and how can we help you provide that? How can we empower you to find that certainty in your life? Thank you.
Grateful to have you tune in today. If you're ready to rethink your financial journey and take the next step, make sure to subscribe. Until next time, stay curious and stay in control.